Good morning, and welcome to today's webcast, Navigating Retail Tax on Heavy Trailers and Tractors. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenter from Moss Adams, Dustin Hubbard, Managing Director.
Thanks, Chad. Thank you all for joining us this morning for a quick 30-minute webcast here around excise tax on heavy trailers and tractors. I'm Dustin Hubbard. I'm a managing director in the state and local tax practice. I've been practicing in public accounting for a little over 20 years now, doing various types of taxes, income, sales, use, excise taxes, working on every industry under the sun, as well as working on all the consulting and compliance associated with each of those tax types. Today, we're going to talk about heavy equipment retail tax. That's a federal tax on certain over-the-road vehicles. We'll go through and give you a little bit of an overview and a background on that tax. We'll give you some definitions and what a taxable vehicle is or what taxable equipment are. And then we'll talk about some exceptions that are based on definitions. Clearly, these things will get more in depth as you look at your specific facts and circumstances, but we'd be happy to talk through that with you either at the end of the webcast or later. First off, I want to start with a polling question, just get a flavor of who the audience is here. So what area of this industry does your company operate, or how does this tax impact you? Are you an importer? Do you manufacture this type of equipment? Are you a retailer or a dealership? Do you buy this equipment? All of the above, multiple of the above, or something else outside of what I listed here? And while you're answering that, I will work or wanted to know on your screen, there's an area for Q&A. I don't know if we'll have time in 30 minutes to get to any of the questions. But maybe at the end, if we do have some time, I'll answer those questions. If I can't answer any questions or don't get to your question, I will follow up via email because we'll get your email from your logging into this, and then I can follow up with you and we can start a dialogue about any questions that I don't get to. Currently, we've got, looks like about 60% of the people. Go ahead and see. I'll give you a couple more seconds to try and get that done. And I think if you're struggling, you can just click on one of the boxes and that will answer the question for you. We'll close that down and move forward. Looks like we have a fair number of buyers, dealerships, and then we've got other. So I'll be curious to see what the report says when it comes to other, what you guys are doing there. But an overview on the tax and what we're dealing with here. The first off is this tax is used to generate revenue that goes into the Highway Trust Fund. The big point here with the trust fund is the benefit principle of taxation. Those who use the highways should be paying for the highways. And so what the tax is designed to do is put money in the coffers for construction and repairs of roads, public infrastructure type projects, and public transportation projects. That money is what's divvied out to the states and the local governments as they move through and try to expand roads, redo roads. And so the point is, with heavy equipment that's doing wear and tear on the roads, they should pay a little extra to cover that wear and tear. And so that's the genesis of this tax. What the tax rate, it's a 12% tax on the first retail sale of heavy equipment. And we'll get into some of those definitions a little bit later, like what's a first retail sale, what is the definition of heavy equipment. But when you fit into those definitions, it's going to be a tax on the value of the truck chassis, the trailers, and the semis themselves. And so there is some equipment that when added to a frame is going to be included in the tax base. And again, we'll get into that a little bit later. But the thing that I think to keep in mind here is these are heavy vehicles that travel over public highways. And that'll come into a little bit more clear view a little bit later. So the first retail sale, unless something taxable has happened previously, typically where I see questions coming up in this is around leases and use. So if a dealer uses the vehicle before they actually sell it, if they put it out on a short-term lease or a long-term lease, those are all taxable transactions, even though they're not quote unquote a retail sale. And so that is when the tax would be due, rather than when they turn around and sell that used vehicle to a third party. There is no tax due on that. The other thing is there are some exempt customers. Again, we'll talk about those a little bit later. And then the other is if it's for resale. I mean, similar to a sales tax, if I am buying a piece of equipment that qualifies or meets the definition of a taxable piece of equipment, and I'm going to just add to it and then resell it, that is not a retail transaction. That's technically a wholesale transaction, and therefore the tax would not be due on that. And so that's where the definition of a first retail sale becomes important. You'll see importers also run into asking this question a lot: is if I imported it, did I really sell it? Or who is the instance of the tax actually going to be on from an import standpoint if I'm just shipping it in and the transaction's already done? So when it comes to calculating the tax base, because of the multitude, and you saw that in my polling question, you can be a lot of different things and have this tax apply to you. And so the IRS has given us guidance on kind of how these taxes should be calculated. And the first thing that I'm going to talk about here, I should probably talk about the actual things that are included, but I'm going to do that later. So the first thing is how do you calculate what your sales price is? And as a manufacturer, a producer, an importer, what the guidance will tell you is that you take the sales price and you add a 4% imputed markup. Because you're not a retailer and there's not that retail markup on the piece of equipment, the IRS is saying, well, you have to impute as though a markup was included on that, and then that's what you calculate the tax on. As a retailer, you're just going to take whatever you sold that piece of equipment for, that's your total consideration paid, that's what you're going to pay the tax on. A long-term lease, again, as a retailer, it's going to be total consideration. So what are you getting paid over the term of that lease? And then as a manufacturer, producer, or an importer that leases over a long-term lease, which is going to be, I believe, 3 years or longer, a long-term lease, you're going to get into constructive sales price. And essentially what you start looking at there, and again, also on a short-term lease, you're going to look at constructive sales price. So what is the lowest value that somebody has sold that same piece of equipment for at retail? If you're a manufacturer and you have a retail dealership arm as part of your group, well, then that's going to be a pretty safe number. You're going to know what your retail entity is selling, or your dealerships are selling that piece of equipment for. If you're just a manufacturer, then you're going to have to go out and look and see what's kind of that lowest price that I'm selling those items for, that other people are selling those items for at retail, and that's what I'm going to base my tax base on. The IRS publication 510 has this nice little chart in it. It just kind of reiterates what we're talking about, or what I talked about on the last slide, but I like to put the chart in there because for those of us that are visual learners, this can maybe break it down a little bit more. And also it gets into a little bit more detail on the constructive price that you see for short-term leases, depending on who you are. But that's basically a regurgitation of the previous slide that I wanted to share with everybody, and you can download that through the slides. So then a definition of taxable equipment and vehicles. So this is getting into a little bit more specifics. And what you're looking at is going to be considered Class 8 trucks and truck trailers, tractors. So what does that mean? And ultimately what you're looking at is big tandem trucks. So think cement trucks, dump trucks that are hit the GVW classification. Again, it has to hit these numbers from a GVW standpoint, or it's not going to be it's not a taxable vehicle, part of the definitional exemption, right? It defines a heavy vehicle as meeting these numbers, and if it doesn't meet these numbers, it's below that, then it's not going to be subject to the tax. But you're talking about, big rigs, tractors, Peterbilts, Freightliners, those types of things driving over the road that meet this definition. From a trailer standpoint, again, it's going to be your semi-trailers that we all see on the highways that you guys are buying to haul big, heavy loads on. And it would also include smaller, like pickup type trailers that are goosenecks. But again, they can carry a heavy load. So typically you're looking at tandem or triple axle gooseneck flatbeds, dump trailers, those types of things could also fit into this classification based on how they get stamped and what their GVW is going to be. Taxable machinery and equipment. So what we're talking about here are things that are attached to the truck. And ultimately, in order to become taxable or a taxable piece of equipment that gets bolted onto the frame, it has to be something that contributes to the transportation function of the vehicle or the load. And so where we see some of this is my neighborhood. They've been doing a lot of remodeling of homes. And so you see the sheetrock get brought into the neighborhood on a flatbed truck. It's got a crane or a boom on it with some forklifts that then pick up the sheetrock and take it up to the second story windows. That type of a crane that is used to load or unload the vehicle is going to be considered a taxable piece of equipment. Towing winches on tow trucks, things that contribute to the maintenance or the safety of the vehicle. So things like speed control equipment, cameras, tire gauge equipment, those things are all going to become taxable pieces of equipment that you add to the vehicle that get included in that tax base. Things that contribute to the preservation of cargo. The easiest example of this is like a reefer unit attached to the front of a trailer. That's going to be something that is going to be included in the base of the trailer. And then items for comfort of the driver or passengers. The things that I can think about here, again, cameras, things that make it easier for them to drive. An interesting thing that I was reading about a couple of days ago, tired alert systems. So things that can tell if the driver is getting tired and struggling to stay awake and needs to pull over. I haven't looked into the details of that, but that was something that I thought was interesting to throw in here and maybe start a little bit of a discussion about whether or not that would be and to be honest with you, if those are attached to the truck or not is the question in my mind on how those would be treated from a tax perspective. And then a little bit of a summary here, talking about taxable parts, essential parts or accessories. That's the other thing. It's got to be essential. Something that, again, contributes to the safety or the carrying of the load, makes the truck or the vehicle go down the road in a safer and a better manner, keeps the equipment or keeps the load attached to the truck or on the truck. Those are the types of equipment that would be included here. It doesn't really matter if these are billed separately, so you can't just separately invoice for those. They improve or repair or replace a component part of the equipment or the truck, or you are used in connection with the taxable vehicle. So again, things like cranes, loading and unloading equipment, boxes, like a dump truck box, because you can buy the frame. Then it's a matter of, what do I put on the back of it? Am I putting a flatbed? Am I putting a box? Those types of things are going to be included in the taxable value of that vehicle whenever it is sold at retail. So we'll talk a little bit here about definitional exemptions. We talked a little bit about the first retail sale. So the tax is only due on that first transaction, sale of used vehicles, leasing of a vehicle prior to sale will be a taxable transaction. Those are items. I get a little bit or a few questions on, is this really the first sale or is it not? But that's pretty. I say that's pretty straightforward, but it can get complicated, right? With some of the transactions that people go through, whether or not this is the first, second, or third transaction is a question that people do ask me. Sales to an exempt customer, that was one of the bullets that we talked about, and I was going to talk about later. Typically what you see is an exempt customer, tribal governments, depending on the use on tribal land for tribal work. And then state and local governments are exempt. If you're selling to the city and county of Denver, where I live, then that's not going to be a taxable transaction because you have an exempt customer. And then also light duty vehicles. Again, if they fall below that definitional threshold from a GVW standpoint, those are not going to be subject to tax. The other thing is, if the purchaser provides documentation of plan for resale, there's no real specific form for this. It can be simply a statement signed by the buyer that they plan to resell this piece of equipment that they are purchasing from you, and it must be executed and accepted in good faith. I mean, it's one of those things where if I'm selling to a construction company and they say it's for resale, I should probably do some more due diligence to make sure that there's some piece of that construction company that is reselling the equipment, or they have some sort of contract in place to purchase and resell the equipment, as opposed to use the equipment, to make sure that I accepted that documentation in good faith. And then off-highway vehicles are exempt. And what we look at here is the ag, earth-moving, forest, mining type equipment. They may meet the GVW requirements, but they're just not made or designed for highway use. You'll see a lot of cases. There's actually been 2 cases that have come out in, I think, the last 12 or 18 months, maybe 3 cases that talk about off-road use and whether something met the definition. One, if I remember right, was a cotton trailer down in the South, and basically what they said is, the trailer is designed for drying, and so they pick it and throw it in the back. I think it was cotton. They pick it and throw it in the back of this trailer, and then it sits there in the field and it dries the cotton, and then it gets hauled over to the facility. And basically it was determined that the design and the reason for the trailer, or what the purpose of the trailer was for drying of the cotton, not necessarily transportation of the product over the highway, even though it did haul it over the highway to a processing facility. It was a short distance, and that's all those trailers were used for. But the majority of the time that the trailer was being used was in the field drying the product in the back. And I changed the product because I think it's cotton, but I could be wrong on that. And then also, is it required to be licensed? And does it have safety requirements, that be OSHA or through registration with state or county departments? That's another aspect of it, where you can look and say, well, this isn't a vehicle that requires licensing, so therefore it's an off-road vehicle and is not subject to tax. And then the big thing that you see in a lot of the guidance is speed. How fast can I tow that trailer? How fast can this truck drive? And is it something that is safe to be driven on the road based on the speed it can go? I mean, if it's got a max speed of 12 mile per hour and you're driving it on 55 or 65 mile per hour roads, is that safe? Or does that mean that it's specifically designed for off-road use because of its low speed? And then we'll talk here a little bit about exempt equipment. And this is probably where we get most of the questions that come in, is stuff that gets added to the trailer or to the truck, and does that qualify, and does that piece of equipment that's added need to be included in the tax base when we're calculating what the value is for tax purposes. And the thing to keep, the simple examples that you find in the guidance and that you've seen in court cases are like crane trucks, right? I mean, they take them and they drive them down to the site, they set the crane up, and then they are using the crane on site, but they're not loading anything on the truck with the crane. The crane itself is the load of the vehicle. And in that case, that crane is not a taxable piece of equipment because it's not contributing to the hauling of the load. It is the load, so therefore it can't contribute to it. And you see that very similar with pumps. We've seen this with fracking trailers that clients have used, where you've got a big pump sitting on the top of a trailer. The pump is the load of the trailer. It is not contributing to the transportation of that trailer in any way, shape, or form. It's the load. And then vacuums is another one. And again, all these things come through in court cases that you see from time to time that come out. But these things, like a vacuum, there's different component parts to a vacuum, and the question is where do you dissect what is contributing to the load or the carrying capacity of that vehicle and what is not, and is the vacuum loading? Because the vacuums, and I hit on this a little bit because I just got done with a decent project on a company that has dry vacs on the back of their trucks. And the vacuum itself, the hosing, the filtration unit. Some of the trucks have hoppers on them. Some of them don't. They just literally suck it up and spit it out on the other side of the truck. But also, are those trucks carrying anything on the road, or is it something where they're sucking up dirt or product or something like that, putting it in the hopper, moving it to a different spot on the same job site, dumping it, and then coming back and redoing or doing more. And so those are the types of things that we really got into as we were going through that project. And luckily there was a decent amount of guidance on vacuum trucks. There's, in all of these things that I highlighted in here, there's a decent amount of guidance in there. So wanted to hit on that. And then another area that is, I briefly put at the end of this presentation, but it's definitely, and I think some of the questions coming into the Q&A section touch on this repairs area of this tax. And if you've been following, I can't remember the court case, I should have wrote it down, but I can't remember it right now. But there's a couple of court cases going through right now on repairs and whether or not the repairs meet the 75% exemption, statutory exemption or not. And basically what you see here in repairs is if you're repairing less than 75% of the retail value of the vehicle, then in theory, that's an exempt transaction. And those repairs are not going to be subject to this tax. Historically, what we've seen are these glider kits, right, where you take an old frame and potentially an old engine and an old transmission, and you put a new body on it. And in those transactions, the question was always, well, what else are you doing? Like, how much repair are you doing to the frame? How much repair are you doing to the transmission, engine? And do you stay below that 75% value? And that's a couple of the court cases that are going on right now. That's what they're talking about, and that's what the courts are looking at. And that stuff, I mean, back when I started my career back in the early 2000s, those were the things that were questions on these glider kits, and whether those should be subject to FET. And I think they kind of cleaned that up. But these new cases coming through where it's not really a kit, it's total rebuild or a pretty substantial rebuild, but they're very careful about whether or not they hit that 75% value or not. And so I think that's some of the interesting areas that we talk about. We've got 6 minutes left here, so I was going to take a look at some of this, some of these questions, and I can talk through these. It might take me a little bit to read. Do you need to make the city or local entity fill out an exemption cert, or is it exempt by default? Interesting question. I would say I would get them something from them. It should be pretty clear on the invoice and in the contract that you're selling to a state or local government, and should be exempt by default there. Would an attachment that provides a service, such as a crushing or cutting attachment that is fixed to a trailer or truck, be a taxable item? I would typically say, just first blush, my first thought on that is no, because I mean that's in theory. I don't. The question's a little vague. Don't get me wrong here, but what I'm thinking of is you've got a trailer body or a truck body that has crushing equipment on there. One of the things that I think about that might be comparable to this, right? You've got a little bit of an ag flavor to it, but we used to grind hay on the farm, right? And they would pull in a trailer on a semi. It had its own engine, but it had a tub grinder that would grind hay. And so we would load bales into the tub grinder, and then ground hay would come out the back end of it. That would not, because that's not, again, the grinder, or in your case, the crusher cutting attachment. Yeah, I'm thinking that's the load of the trailer. That is not the, it's not contributing to carrying things down the road. It's the actual load of the trailer. And therefore, first blush on this, again, don't take this to the bank. This is very, very high level guidance or thought process and quick off the cuff answers here. We could dig into the facts if you'd like me to follow up. We can definitely dig into the facts on that. But first blush, I'm thinking that's exempt because it's not contributing to the highway carrying capacity of that vehicle. It is the load of the vehicle, and that tends to be, when you look at the guidance, that tends to be the structure and the reasoning behind that. So in 3 minutes, I might struggle to answer another one of these. You're buying these vehicles. I previously respond. Oh, I missed that. Chad, how about we go ahead? I'll respond. The rest of these questions, I'll tie those together and get some emails out to people to connect, and we can chat through those. But Chad, I think just in the interest of time and respecting that and me not rambling for too long, I'll turn it back over to you. Again, thank you guys for your time today. I appreciate it. And we'll go ahead, Chad, if you want to close us out.
Yeah, thank you, Dustin, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.